The world's fastest growing market is in something that does not exist. Negative yields are mutants born of central bank intervention in markets, and investors who don't believe those interventions are going to bear the fruit of higher growth or inflation anytime soon. 18 months ago, negative yielding bonds did not exist. Now they account for a quarter of the universe in government bonds, and they are still growing. On Monday, markets were carrying the imprint of Japan's surprise easing last week. After years of holding rates close to zero, the Bank of Japan took the plunge and introduced sub-zero rates on Friday. The unexpected move had the desired effect of shocking markets into action. More than $1 trillion of government bonds with positive yields dropped into negative territory in the space of 1 week. It has been one of the most trying starts to the year on record, with investors consumed by fears of, in no particular order, China, oil, emerging markets, and the risk of recession in the US. Emerging markets and high-yield bonds posted negative returns in January, while equity markets in every continent slumped. The S&P 500 was down 5%, the Nikkei dropped 8%, and Europe's stock 600 fell more than 6%. So will February be any different? There should be plenty of incentives for markets to calm down just a little, but global stocks are dropping on the first day of the month, and prices for safe haven bonds are rising. The yield on benchmark 10-year Japanese bonds are now edging towards zero, down to a record low of 0.02%. German government bond yields are following suit, with Germany's 5-year yield hitting a new record low of minus 0.32%, as European investors wonder whether the ECB might copy Japan and pull its own rabbit out of the hat at next central bank meeting. But remember what happened in December. Raised expectations of ECB action were dashed, and the rally was replaced with a sell-off. The universe of negative yielding bonds will be finite.